nasty provision in which says if the meeting does not begin within 15 minutes of its scheduled time, it has to be abandoned. So that would have been rather frustrating. So I think we're just in on time. So apologies, starting slightly late, and apologies on behalf of my colleagues for that. So formally, Mr. Trahan, we have apologies for absence from. Thank you very much. Are there any declarations of interest anyone wishes to make? No, I don't believe there are. I'm actually going to slightly change the agenda just because we have quite a lot of guests this evening. And so I'm going to propose in a second that we move into part B, because I think all of those guests are going to speak to us on matters that are confidential. And we'll come back then to the minutes, the Part A minutes and the rest of the agenda after we've done those things, just so we can allow our guests to enjoy as much of their evening as we can. So I'm going to formally propose and look for a seconder that we move into Part B. I think Councillor Bennett, are you seconding that? So we will move into Part B. Do we need to just wait for So the ESG strategy, I have to admit, I have been signally poor at providing a response, but I actually think other than one member, Mr. Hubbard, no one else has either, but I may be wrong, Mr. Triggs. No one else has also provided. Okay, well, we're all very dilatory. We must do so. I think there were concerns. I mean, quite a number of us had concerns and thoughts on this matter, but unless we actually provide them to officers, they can't progress this matter. So the action is with us as the committee. I will assume responsibility for trying to round up some people. I'm looking at particularly my councillor colleagues. I think it's important we provide our comments. I think we both, all of us express views on it. So we must do so. And I'd invite any other of our co-optees to do so, but we must put this in place. The RAFI strategy, I think, has been overtaken by events, the second one. The rebalancing policy, I think we're going to talk about later. The passive equity transition update email was circulated, and that's complete. I mean, before we've done the more recent aspect. Paper A10 on the quarterly performance review. Risk register. So officers, I suppose my question here is, officers believe that is not really the answer. It's what does the Constitution say? And I think we've always avoided this committee having involvement in administrative matters and risk matters just because that's not the way we've been formatted. And my assumption had been, anyway, that I haven't checked the Constitution, that the pension board would do this, give them something to do. If it is indeed our responsibility to manage the risk register, that's a new thing. And I suggest if it's not in the Constitution, it needs to go through the administration committee, and we need to decide whether we're happy to take on that responsibility.
Chair, specifically on the external auditor's findings report, that is mentioned in the terms of reference. So we can tick that one as being mandatory, required to be within any agenda on an annual basis. With regard to...
Sorry, just help me, which is that little two that you're referring, which of these three? Oh, I think you're looking at the next action one.
Yes, that's it's a separate one from this, but it's yes. It is mentioned specifically within the.
That's in our terms of that's in the Constitution, is it? So yeah, the 7th of December 2021, A12 Council Annual Report one. You're saying that is specifically what I think we have always done that in the past, but it was worth checking. But going back to
the risk register. I mean, in terms of the terms of reference, it is specific in mentioning obviously the investment strategies, asset allocation, good stewardship of the fund, the publication and agreement of the investment strategy statement, the funding strategy statement, business plans, governance, compliance, ESG considerations, and all other policy documents. So it is the officer's view that with a fully functioning risk register that is hopefully all-encompassing on all matters of risk, which obviously would affect the compilation and approval of those aforementioned policies and statements, then the committee should have a kind of all-round view of the risks currently faced with a view to good governance and good decision-making.
I think were we to assume this, then we need to be very clear. We are an investment committee, not a pensions committee. And other councils have pensions committee. I know Westminster, for example, does. And therefore, that committee is involved in looking at issues around pensioners, which we do not and never have, and I don't think have any intention to do so here. So that risk register would have to be edited and filleted to ensure it's solely related to risks that relate to the investment policy of the investment of our assets. And I think we need to be very clear as a council, who is in turn looking at the other side of the pension fund, namely looking after the interests of pensioners. But it is not this committee.
Well, in that case, Chairman, could I suggest that the committee retains responsibility for the investment and governance risks, and maybe shelves the administration risks?
Yes. So if that's, I think we should check whether what's actually in the constitution, and if this is silent, it may be one for the administration committee to be explicit on, and make sure that those risks are being properly overseen by someone. I mean, it's very, very important. That the reason I raise this is that risk registers are very, very important, and I don't want a lot of sort of finger pointing saying, oh, well, we thought you were responsible, and no, we thought you were. So if we're very clear about what we're doing, then we'll do our bit, and the other bit needs to go somewhere else.
Well, the Constitution and the terms of reference are silent on a risk register per se. So it's only those other responsibilities where, in my view, a good appreciation of risks currently facing the decision-making processes, that those should be there for the committee to track and to comment on. But
I suppose risk is absolutely essential and essential to everything that we do, but we're defining it quite narrowly. So we're not looking at, for example, the risk of systems failure, meaning that pensions aren't paid. We should be looking at investment risks, which we do. So if that risk register is narrowly construed in that way, then I would suggest it's just a useful summary of things that we're looking at now, and that seems quite reasonable. But what I was keen we don't do is somehow get implicitly responsible for something we've never done in the past. If that's the decision of the council to change the constitution, make this committee a pensions committee, not an investment committee, then so be it. But it never has been in the past. So, colleagues, this is seemingly technical, but actually fairly important, because you'll be aware that there are many, many issues in local government around the payment of pensions, and I think we've had some issues around it too, and that's just never been within the competence of this committee, and I don't want us to assume that responsibility without actually understanding what it means. Colleagues, are you happy for us to ask officers to come back maybe at the next meeting with a proposed risk register and a very clear definition of who's doing what? Essentially, this is the bit you're doing, and this is the bit someone else is doing. I would point to the pension board. I'm still slightly at a loss as to what the point of the pension board is. So maybe someone knows, but this seemed to be a very good thing for them to be doing, but maybe it's not.
Certainly, Chair, we will take this away again and come back to the next meeting.
Yeah, if we could just be really clear. Thank you. Sorry to belabor the point. And then the valuation figures that you've done. So Northern Trust need to just do some more work. So we should keep that on the action tracker until it's complete. And the nominal benchmark rate is included now. This is on property, I presume. Yeah. Okay. Thank you. That's all the action tracking. Good. We've had the Adam Street presentation. We've had the direct property update. So the next paper to consider is paper A7 on private equity commitments. Clearly, the presentation we've just had from Adam Street is informative. Again, officers, Master, are you going to either or both speak to this?
Okay, so we were asked to look at the commitments proposed to private equity. As you'll know, the fund made a running 3-year commitment back in 2018 to help rebuild its private equity exposure through Adam Street Partners. We've come to the end of that period now, and we're looking at recommitting to another 3 years, and the question is how much. Adam Street have provided 4 scenarios which we've looked to model, and we've provided another 2 scenarios with a more kind of steady commitment pacing, and these are set out in our presentation. I think the first thing to note is this analysis was done as at 30th of June 2021, which is why in some of these scenarios commitments are paid in 2021. We modelled the Adam Street scenarios and compared the results to those that are presented by Adam Street, which I think is in the appendix of their presentation as well. The thing to note is that as at 30th June, the allocation to private equity was overweight, and we can see in our presentation we have a dotted red line of where your strategic allocation is and how we expect it to increase over time. There's a kind of a pound amount And then we show some very similar results to Adam Street as to when, by committing more money, you would see the current allocation drop off. Without putting new money into the private equity, it kind of runs off by 2033. So a recommitment is required to maintain that strategic allocation, but being mindful that you're overweight. In summary, just turning the pages to the scenarios that we modelled, we looked at committing less money than suggested by Adam Street. Adam Street were really looking at commitments of about $30 million per annum over 3 years. We looked at two scenarios, A and B, and the scenario A looks at putting $10 million in years 2022 and 2023, and then upping that to 25 million, 35 million, and 35 million thereafter from 2024. And for us, this results in the allocation coming back towards the benchmark, 5%, the strategic allocation, but benefiting from putting some money to work in these each year in each of the vintages. And we think there's some benefit to that, because we've heard from Adam Street how it's hard to time investments into private equity. So by having some money going in each year, you ensure diversification. But was suggesting that you could afford to put less money in than in 2022 and 23 than Adam Street were suggesting. So our preferred scenario would be A. I would also caveat that by saying this modelling is underwritten by assumptions, and clearly we're at a point in markets now which markets could be very different over the next few years, and so it would be sensible to keep this under review. I think if you're committing to a smaller amount, you can always increase that in 12 months' time if it looks like the allocation is reduced relative to the rest of the assets. Whereas if you go for the larger amount, then clearly you're kind of tied to that.
Can I just ask on your assumptions, the expected growth of AUM of 4.9%, so that's essentially your assumption around how rapidly the overall fund would grow, and that's presumably net of cash flows from contributions and payments. So that's our 4.9. And then what assumption are you making in terms of the return on the private equity investment?
Yes, so our return on that's absolutely right, Chairman. That 4.9 is the kind of expected return on the overall assets based on our assumptions. Page 9 has our private equity return of 10.8.
So you'd say
10.8. For comparison, Adam Street were using 15.2. Okay. So a higher expected return for the private equity. But if you look at the results of what we modelled for their solutions, the scenarios, the results are very similar. So despite those differences in the assumptions, I'm not too sensitive.
So the reason I was asking that, so mathematically it must be the case that we must be a net withdrawer of funds over time, because if their 5% is going up by, call it 10, and everything else is going up by, call it 5, mathematically it means each year the weighting in the overall fund must be increasing. So we would be permanently haircutting this investment. I mean, just mathematically that must be the case.
You're absolutely right, which is why when you're overweight already, we're suggesting a smaller amount.
Exactly, and we all know that the actual path won't be quite so smooth, but at least in forecast terms. So what I was just conscious of, and has always been the advice we've received, is to avoid trying to time vintages and to change profiles. So is there a number, if you sort of stick it in Excel and goal seek it, which says, given we're going to be a net recipient of cash from this, because otherwise the weighting will go up by definition on those mathematics. Is there a number, or is there a pathway which is a sort of smooth pathway as opposed to dropping a couple of years or halving a couple of years? You know, something which avoids that timing piece, but which doesn't mean we keep coming up against this problem every year.
Yes, well, we looked at those two scenarios, A and B. And in B, you don't make any commitments for the next couple of years and then go back in. But we thought that the smoother approach, as you say, is scenario A, where you do keep up some level of contribution to benefit from the diversification of going in different vintages, and then look to increase the allocation in years 3 and 4 onwards. So scenario A.
Yeah, but is it? I mean, that seems quite it's a 10 to 40 rather than, I don't know, 20 now and 20 in 5 years' time. So I mean, a more smooth. There's still a slope there.
So you were thinking if we put kind of, rather than putting a 10 in now, put say 15 in now.
It's just a question, I suppose. If we're unless we're abandoning the sort of market timing, vintage diversification point, sort of almost what's the number, which means we're not taking a view on vintages. We're just steadily every year putting some money aside. What is that number versus us missing a beat or?
Yes, well, historically, in the Adam Street presentation on page 8, it shows that you've historically put in 2007, 2008, $35 million, and then 2012, 30, 16, 20, and then the last 3 years, 30 million per annum. So if you were not taking account of your asset allocation and the fact you're overweight, you'd carry on putting in the order of 30 million in per annum.
Yeah.
Of course, if the 10% or 15% is really a credible figure compared to 5% for the overall fund, then that would suggest the asset allocation ought to be higher than it currently is.
Yeah, I mean, indeed, if their expected return is actually closer to the actual fund number, then the amount we should be putting in should be higher. So your advice is, this is a hard one, but I suppose, yeah, I think all I was trying to get at is that I think the modelling is very useful, unless we're actually taking a decision that we want to actively avoid investing in this vintage. We want to try and get to a number which solves for the rebalancing point, but which doesn't lead us to missing a couple of vintages and then saying, oh, that was a bit of a mess, and then over-investing catch-up terms later on.
Exactly, Chairman. And of course, to keep it under review, so in 12 months' time, if the position is different, you could always allocate more.
Council?
No, I just wanted to check that I understand what you're saying. You're saying sort of, let's say, 25 million, and then, you know, invest that 25 million for a number of years, and then in 5 years' time we might say, okay, actually we need to up that, but pick a number which we think we can stick with sort of almost in perpetuity or inflation linked.
That was so exactly, that was sort of what I was trying to get at.
So we're not trying to reduce sort of smooth the curve, we're trying to get no curve at all. Yeah.
Ideally, and just avoid the situation that what we do is we go and miss out a couple of years to rebalance, but those happen to be the best years.
Yeah.
You know, in 10 years' time when they're coming and say, well, you missed the great years. I mean, well, that's rather annoying. We were doing it for rebalancing reasons.
Well, I mean, yeah, my view would be, especially considering how overweight we are in cash at the moment, to go down to say 25 million rather than all the way down to 10, and then in 4 years' time or whatever, reevaluate whether that's too much or too little. I don't know if 25 is the right amount, but that sort of figure.
Co-optees?
Three questions. In your rethink, did you put any brainpower into whether the 5% is the right number? Because if our view on risk is changing, should it be 5, 6 or 7? Or have you just held on to that as doctrine? Next would be, what are we going to be paying Adam Street? And I guess the supplemental, do we care about those fees?
Well, just briefly, we did consider the appropriate level of exposure in the last meeting, and that was around the question of, is 5% the right answer? And we came out saying that we thought that 5% was appropriate, and therefore, actually, this modelling is around trying to retain that kind of level of exposure. On the question of fees, this is a relatively expensive investment, and one should just be aware that's the nature private equity, there are quite attractive fees that the fund achieves, that you achieve, because you are pooling your assets with all other local authority assets with Adam Street, so you get a better rate than otherwise you would. But on the other hand, the fees are high.
I was thinking kind of reputationally with our members and constituents, whether paying these sort of things, that these sort of rates is something we've thought about and whether it's defensible. So maybe that's a question this way rather than that.
It is notable when you look at the accounts, which are later on in the pack, that the fees for Adam Street are very, very significant as a proportion of the whole when you take out the property acquisition costs. I suppose the argument would be, which I think Mr. Butlin's argument, which is if you want to access the asset class, it's better to pay fees and get the returns. Now that's a question of whether you really believe you're getting remuneration on those fees and whether the asset class is a good one. But I don't think there, I don't know of any other cheaper way to get into this. There's no sort of tracker equivalent.
I mean, some of my funds, also on reputational grounds, won't touch fees over a certain threshold because they just think it doesn't fit with their audience.
Yeah. I think we are fee conscious, but I think historically we've sort of through gritted teeth accepted these ones. But we're pretty mean, as you know, on certainly equity managers. So, colleagues, does anyone have any strong views on the pathways here? I mean, there probably is many variants as as hours left in the day or minutes left in the day. So the recommendation is option A, wasn't it, from Mercer's option A. I'm slightly in Councillor Bennett's camp though, which is it just feels like what we're doing is we're obviously reducing the short-term amount to get that curve to dip down back to the dotted line. But it does that we then introduced a sort of investment skew to get that. And I recognise, I think it was Mr. Davies' point or one of our team's point that of course this is highly assumption dependent, and therefore if the thing's not really returning 15 but it's returning 5, then actually you then go underweight when you get the real numbers. Colleagues, does anyone have any strong views on this? Because I think this is one where if we've been given advice, and I think we're all slightly therefore grasping, I would be tended to just follow the advice. Ms. Hubbard?
I'm a bit concerned about hanging this off the 5%, which is a fairly arbitrary hand wave that we sort of guess that's not too far from where we'd like to be, rather than actually thinking, what's our appetite for risk? If we let this exposure run a bit higher, because of the relative success of their pedigree, etc., would we have a better outcome?
I mean, one solution would be just to maintain the level of commitments for another year, and actually which picks up the risk register, picks up our conversation around RAFI, and relook at our overall asset allocation, and particularly from a sort of risk perspective. We've done this not actually that long ago. I believe we had a meeting with the leader about 2 years ago on this very subject. But maybe that's the way to go, which is another year of 30 million is not going to really change anything very much, especially given a commitment now won't actually be invested for some time. And then to pick up your point, see it in the round and say, well, actually, is the 5 is the really big number, not the 30 or 35. Do you think that works?
I mean, that's my bias. I don't like playing fantasy football, just keeping it running at the same rate. Seems entirely reasonable, but I would come back to this is a component of the risk in the portfolio. It isn't a risk per se.
Yeah. Colleagues, just shout.
I was just going to say is it the next agenda point is very relevant to this, the rebalancing one. So if we make one decision here and then make a different decision in rebalancing, or decision we make here is not is different to the advice that we agree to in the next agenda point, and that might be a bit contradictory.
I mean, that is a good point. Assuming that we follow the advice in the next one, that does say 5 plus or minus 2. So actually, in the short term, there's no pressing need on that policy to worry about rebalancing. So we could be at 7 and still be within our rebalancing policy. I think that's a good point. colleagues, my proposal then is that we just stick at what we've been doing for the last year. But I think yes,
I think that's very sensible. Just keep committing the same amount and reevaluate it 1 year.
Okay. So, officer, so I think we're just to be clear. Historically, we've been tracking at 30. Mr. Hobson's nodding. Did we? No.
We only authorised 3 years for 30 million. And then in 2021, we got into discussion about what is the right amount, as we're doing now. We'll have to get off down.
Okay. Well, we don't want to do that again. That's not good. My fault, probably. So, but in 2020, it was 30 million. So I think what we're saying is for 2022, we should do 30 million, but we should look at the bigger picture and see this in the bigger picture and then come back to this for 2023. But what we should do, I think, is try and decide in 2022 what we want to do for this for 2023, not do it on a year by year, piece by piece basis. But I think this is extremely useful, and we might need to keep asking you to do various variants on it, depending on where we come out on the bigger discussion. Colleagues, does that meet with your agreement to do that? Nods from the far distance. Good. Mr. Trahan, are you clear what we've just decided? So we're going to commit $30 million for the 2022 vintage, but we've also asked that within this year we should revisit the 5% and indeed our overall allocations. I suppose the property piece gets picked up in that too, just to see where then, when you apply these numbers that Mercers have done for subsequent years, what we might want to do. Okay, good. Shall we move on then to, indeed, the rebalancing policy? Who's talking to this?
Thank you, Chairman. So this has been to the committee on a number of occasions. It was the request of the members that we go back to the drawing board, make the thing a bit more robust and resilient. Mercer have assisted us greatly in that quest. So the revised policy, which is included in the appendix, Chairman, goes into far more detail in terms of the asset classes and the types of rebalancing that should take place. We've adjusted the review ranges slightly and then talked about specific scenarios with regard to specific asset classes, including equities, cash, property and private equity. And happy to pass across to Mercer if there's any further comment from our advisors.
No, I mean, it's set out here. It is intended to provide a little bit more detail about what would happen in particular circumstances, how the rebalancing would work in practice, what, for example, would be the priorities, what to be looking at the overall amount in equities first, for example, and then go down to thinking about which managers to move to bring back to the neutral position. So there is more detail, and there is more of a differentiation between the way in which public markets are treated, the more liquid markets, and illiquid assets, in other words, the property and private equity, where rebalancing is less straightforward.
Colleagues, before we debate this, can I propose that we formally change the asset allocations as shown in the report to remove the reference to the Elgin Rafi Fund. Therefore, as part of that proposal, the asset allocation to that should be 0, and that the asset allocation to the BlackRock Global Passive Fund should move from 45% to 50%. Obviously, we're now in public session. We had a conversation around this earlier. I think that's just good housekeeping. But formally, can I propose that? If you can second it. Councillor Bennett seconded that. Colleagues, is everyone happy? That's pause on that bit. I'm just essentially doing a bit of housekeeping because this table reflects where we were until about half an hour ago. But so I think that's agreed. So we're changing the asset allocation. The RAFI goes to 0, gets deleted, and the BlackRock goes to 50%. We haven't otherwise discussed or changed anything else. So then just them moving out of policy. There are lots of ways of doing this, and we've debated, I think, on a couple of occasions. One of my outstanding questions to you is, how do we manage this with our committee cycle? So the way I understand this to work is that at any given point on any given day, to the extent that we were, for example, 75.1% allocated to equities, that should trigger on that day a rebalancing, which doesn't really work with the way we do things, short of using urgency procedures on every occasion, which is not really how it should work. So how's that going to knit with our governance?
And I think that's your choice of whether this is really a subject for officers to take charge of and to have responsibility for rebalancing, or whether you would wish any move to be ratified by this committee. And if you do wish it to be ratified by this committee, then obviously it should move into a quarterly cycle rather than being an as and when.
Again, colleagues, I welcome your views, but I think this is fairly important, and for officers to be doing this under sort of delegation seems strange. I mean, these are quite significant moves. You could be going from, 5% of our fund moving, albeit under rules, but without reference to the committee seems a bit odd, but others may be more relaxed about that than me. So, as drafted, it would be, as I mentioned, if you get to 75.1, it should trigger an immediate rebalancing. I think this is what I was pushing on last time. A calendar process is you look at a particular day and test it on those particular days. So you could be at 75.1 today, or rather, well, let's say tomorrow, 75.1 tomorrow, but by the next meeting, we're back down to 74.9, and that's the moment that we look at the numbers, and therefore nothing has happened in the interim.
I think it'd be straightforward to do it on a quarterly basis with the officers reviewing the position, making the recommendation, and then seeking ratification.
So would that be on quarter days?
I think quarterly is an appropriate time frame.
So to be absolutely clear, what you're saying is that on the quarter days, which marries with what Northern Trust do for us, I believe they do it on quarter days, don't they? That we'd look at the asset allocation on the quarter day, and then at the subsequent meeting, which could be in the November meeting, for example, 2 months later, irrespective of what's happened in the meantime, unless we choose to do a manual override, which we shouldn't really be doing, we would do a rebalancing agreed in November for the September valuation.
I think that could. I mean, I think that could be a manual override. If one's aware that markets have moved exceptionally since the quarter day.
How hard would it be? I'm sorry, I'm just trying to. This could improve to understand the practicality, so we don't commit ourselves to something which just doesn't work. How hard would it be to have a valuation which is get it from Northern Trust, say a week before our committee meeting? And then use that number, because I'm just conscious again that you could always have some quite perverse things where the 30th of September valuation is way off where the November actual valuation is, and then we're almost sort of asking officers to rebalance to a sort of fictitious allocation, which could be completely at variance with reality.
Chairman, as you say, the figures that we report are from the latest quarter end. My suggestion in terms of a policy for reviewing the balancing position is that the variance, if it reaches the variance level for which a rebalancing might take place, if that is triggered, then that could be the trigger for a conversation at the committee rather than an automatic rebalancing. And the committee could be found, I mean, wouldn't have been an issue today for us to take a valuation as at today or yesterday and bring that to the committee for the very, very latest position. But
Chair, logistically, I mean, aren't there 2 quarter days between now and the next meeting? When's the next meeting? Is it July?
Help me, it might be. Yes, you're right.
So the logistically, it just doesn't really work.
But you would still, the committee members would still get a position as at 2 days ago, and would be furnished with.
But Councillor Arlo is right. So if on the end of the first quarter the numbers were at 75.1, we wouldn't have a chance to act on that. So I think, Mr. Truggs, on your proposal, that would have been the red flag to say, okay, it's now the 14th of April, let's have a chat. But there is no opportunity for a chat till July, by which time actually you're into Q2.
Yeah, because the next quarter is March, then June afterwards. So it wouldn't be making a decision on.
I mean, if we're asserting that we want to retain control as a committee, it would seem to me the easiest thing is to just take the committee days are the rebalancing decision points, and you just try and get a valuation from Northern Trust X days before it, and we, if it's 5 working days or something. But my question to you is that practical? I can't see why not. Northern Trust should be able to give us a valuation on any day we ask for it, shouldn't they? Is that wrong?
Chairman, just to clarify, so it's difficult to get a full rebalancing picture at short notice because a lot of the assets are not valued regularly. So whilst we can get equity positions very easily and cash positions, obviously properties valued annually, private equities, our valuations are about 5 months in arrears, and only on the quarter days are they truly accurate. But we can get a rough estimation in pretty reasonable time frame of probably a week or two. But it's probably a week at least to get an up-to-date valuation. But again, that would not include property or private equity.
And property is only actually valued once a year, I presume, for the annual report cycle. So I mean, and private equity, we all know, is a fiction in terms of what the number is, because we talked about it earlier. So I mean, this is why I suppose I was going back to where we were before, saying, well, why don't we just do an annual one when we've got the numbers, and then we do it. I think your view was to use these ranges and.
I mean, I still think that it's not that difficult to do. I mean, the annual one would have the same issues of, can you actually get the up-to-date position, or do you just do it as at, the 31st of December or whatever? I think there is, I think it is feasible to get, a pretty close position for an investment committee meeting and decide on the back of that. And at a certain level, it doesn't probably matter if you're 0.1 or 0.2 kind of either side, if the rebalancing is the important move.
Councillor Bennett, then Mr. Diaz.
Well, I was just going to say, according to the paper, which I think is sensible, we treat rebalancing of property and private equity quite different to equity, and so therefore looking once a year, for example, at property and private equity, which doesn't have to be at the same time for the two of them, but based on when we get valuations, seems like a sensible thing. Whereas equity we could look at every meeting, or I mean, I think the point you raised, Chairman, in a previous meeting was particularly with the equity, we should take, I don't want to put, I'm not quoting you verbatim, but I think you said, words to the effect of we should take the human element out of it, and it should be automatic. So then, just to play in devil's advocate, should we actually be bringing that to committee, or should we just be triggering it based on the rules we've agreed at committee?
Yes, I mean, I think that's right. I suppose it's, are we happy then to say to officers, here's a set of rules, go and follow them, irrespective?
Yeah, I think for the equity element of the portfolio, whereas the property and private equity, because of the differences in how they're valued, I think quite rightly are more subjective decisions and should come to committee.
So just to play that out, what that would then mean is that officers would apply that test at the quarterly valuation point, or permanently. Should be permanent, shouldn't it? But then you'll need to get a daily feed from Northern Trust, which is quite interesting.
We do get up-to-date valuations, performance reports every month, so that we get a good idea of when something is going to be running close to its target rebalancing point. So then we can, if it is getting close, we could seek daily valuations, as we have done before. specific situations like when the 2020 crash happened, we were seeking daily valuations to keep up to date with what was going on. So it can be done.
My instinct is for you, this is one of these ones where the scope for something to go wrong and you to miss something could be quite high, and then you'd be outside your authority, and we'd all be jumping up and down and getting cross with you. So not sure that's very good by design for you to enter into that. I would have thought that for you, having a fixed timetable, say quarterly or monthly or whatever it is, where you applied the test and then you acted, probably in consultation with me, I think, because technically it would be an urgent decision, unless we delegate it fully, would be easier. Because otherwise, for officers every day to have to check this, and one day they forget, and then that's the day it should have happened, and then we say, why didn't you do it? Would be rather putting our necks in a noose, I'd suggest.
But also, if you take the crash at the time of the pandemic, where I think markets went down by 30% over the course of a month, you'd be presumably incurring a lot of transaction fees and buying stuff every day, and then it sort of recovered fairly quickly and selling stuff. So monthly, on the face of it, seems to make sense to me.
Monthly or quarterly, and again, I'm looking at others. There's quite a lot of experience over here in terms of how other people are doing it. I'm interested in your collective thoughts.
And they are, of course, quite wide ranges. So this isn't going to be an activity that you're going to be carrying out very often.
So how would that? That's a really interesting point. March 2020, equities crash. Even if you did it on a quarterly basis, could you find yourself in a situation where, and maybe this is desirable, and indeed the whole point of rebalancing strategy, that in March 2020 you're actually putting cash into equities, and by June 2020 you're actually taking it back out again?
Of course, that's possible, but that would be very unlikely. It'd be an extremely rare. Well, I think.
This is as unlikely as a March 2020 event. Yeah,
2020 was exceptional.
Yeah, well, they seem to happen. Yeah, they happen. They do happen, and we want this policy to be robust to that, because again, especially if officers have delegated authority, they will want the cover that we've actively considered it, and we in turn need to understand what we've just agreed, so we don't say, why have you done that? Ironically, of course, had you done exactly that, bought equities in March 2020 and then sold them again later in the year, you'd thought that's exactly what a rebalancing strategy should do for you, which is buy low and sell high.
Chairman, my overwhelming preference would be to bring the scenarios, bring the reports, bring the figures to you on a quarterly basis at these meetings. If the trigger point is reached, then have the conversation with yourself and the members at the meeting, and for these decisions to be made at this meeting. That would be my preference, Chair.
Okay. That's a strong piece of advice we received from our officers. Could I add a rider, though, which is there's nothing to stop us convening if we need to a meeting. We have to go through the proper governance. I think Councillor Lowry's point is a really important one. Our meeting schedules are not evenly spaced, and they are rather random. And you could find, therefore, our portfolio has, again, picking up a March 2020 point. The second quarter 2020 would have been a really interesting one, where these ranges could be seriously blown through, and we'd be sitting there waiting till our July meeting. So I think if we were to do that, I think we'd have to have a rider which is subject to governance, which is whatever the notice period is. Mr. Traherne can advise. Mr. Traherne, how much notice do we have to give if we want a formal meeting of this committee? 5 clear working days, or can we do it under urgency? And so for example, could we undertake a rebalancing decision as an urgent decision? Thank you, Mr. Curtis or Mr. Traherne. So, and then the same could apply, which is we could convene an informal discussion with the committee, which would inform my view, which would in turn inform what I said to you, but you would be the one taking the actual decision at that time. Colleagues, are we happy with that? Sorry, so again, seems a bit technical, but it's actually rather important, because having a really good, robust policy which we follow, I think, is a key part of risk management and good investment management. And I think we have had the rebalancing policy in the past. I don't think we've really written it down very well. And if we're going to do this, we now really must follow it very, very explicitly. And I think it probably needs to be an agenda item on every meeting, or it has to be now an agenda item on every meeting. So are we happy with it? And Mr. Hand, I hope you managed to capture that. So Mr. Trigg's recommendation is that at every committee meeting, we will look at the asset allocation to the extent it's out and follow the paper as it's set out. But the test point will be the quarterly valuation preceding our meeting, and at that meeting, our job is to follow the policy except in exceptional circumstances. So technically we of course do whatever we like, but we're trying to bind ourselves to the mast of following the process and not doing a subjective override at every meeting. And that in the event that one of those quarterly tests shows a need for action, but there isn't a meeting in the subsequent quarter, we will use the urgency procedure to take a decision effectively as a committee, but actually technically Mr. Curtis taking the decision in consultation with me. Does that work for everyone? Yeah, probably late at night is a good way of getting agreement. I think, is that clear? Officers, are you happy with that? Yeah, okay, thank you. Right, what do we get to now? A quarterly performance review. This is for information. Interesting on 5.4 in terms of rebalancing and the Bailey Gifford decision. I think that's exactly the point, isn't it? The same thing. Buy low, sell high. Ironically, now we would be potentially looking to put money into Bailey Gifford at some point. One small point you might check with them is I know in the past the Global Alpha strategy has been at least soft closed. Can we just confirm with them that they're happy for us to sometimes put money in and sometimes take money out? Because I don't want them someday to say, oh, you can't put money in.
We've already confirmed this with them that they'd be happy to do that. Okay. As we are potentially looking at a rebalancing edition, considering the incredible fall the last month.
Good. Colleagues, were there any things that struck you on any of these reports? I would draw your attention to, was it page 3 of the, who's doing this? I've lost sight of, who is this? Which consultant has done this report? The one that's appended to the paper A9. Who's Catherine McFadden? Sorry?
Oh, Hyman's, Robertson.
Right, Hyman's. So these are our actuaries. But I just draw your attention to that table on the bottom of page 3 of their report, which is actually really important because that's showing essentially how much can we absorb as a fund in terms of they've used the FTSE 100 as a proxy, which is not the best one, but basically a 30% drop in the value of our fund would still leave us we're essentially able to pay pensions on their assumptions, 20 million odd. And of course, the way their assumptions work is that as markets fall, their expected return for the fund goes up. So actually, you would never move horizontally to the left. You'd move sort of towards the northwest in the way the actuaries work. So, it's really important for us in terms of these risk conversations. The reason that we retain such a high level of allocation to risk assets is because we have this big buffer, which means we can always still pay the pensions. I think were we 100% funded, we'd have to take a different decision around risk. Anyone else have anything? No? So we then skip about an inch of paper in our packs for those of us with paper copies. And we get to climate strategy and reporting, and this is for decision. So, officers, do you want to talk about this?
So thank you, Chair. This arises from two sources. Firstly, the Task Force for Climate Change Financial Disclosures, which is a scenario that affects the private sector pension funds currently, and was the bit of legislation passed by the Department for Work and Pensions. Now, obviously, the local government pension scheme is under a separate department, Department of Leveling Up, Housing and Communities. So at the moment, this is, as far as the LGPS is concerned, it's best practice for which there is future ambition that the LGPS will conform to the task force requirements in terms of financial disclosures within their financial statements and governance papers. That consultation we have been waiting for, along with a number of other papers that are due out from DLUC. We are told, reliably informed, that in terms of the task force requirements, that will be bundled up with the consultation on pooling, another consultation for which we've been waiting for well over 12 months now. So these are promises made by the department in terms of the conversations that we have with the senior civil servants and local government association advisors, which are due out imminently. So as far as the LGPS is concerned and how they're affected by this bit of legislation, we are informed that we can take this as a starter point to which further requirements might be added on. And then in terms of the RBKC, the council, who have issued the target to be net zero carbon free by 2030 and achieving carbon neutrality within the borough by 2040. And this commitment applies to the pension fund specifically. So in terms of the financial disclosures on carbon and carbon impact within the pension fund investment process, this is something that the Tri-Borough team has been working with in its Westminster responsibilities and Hammersmith and Fulham responsibilities. With Westminster, it's on record that since we started measuring carbon impact, we've reduced that impact by 60% over the 2 or 3 years since those measurements.
Can you just, what does that mean? 60%? Is that the molecules of carbon dioxide emitted by committee members?
That's the total carbon impact of the pension fund investment portfolio.
But how would that be? That's the number of pieces of paper that are printed for the committee reports.
Do you want to explain that?
It's essentially your share of each company. So your percentage share you have in the company, what does that equate to of their total emissions? So how much are you technically responsible for? It's scope 3, it's not scope 1 and 2 in the council's eyes.
Okay, so that's then completely skewing their investment decisions.
Decisions are made purely on for that reason. It's more of a looking at it as a risk management perspective rather than, and this is then purely to lower carbon emissions.
But the market's already incorporated that. Anyway, sorry, I'm interrupting.
The intention, Chairman, is not to compromise the investment process or the investment return. And what should be stated is that despite achieving those reductions in carbon impact, it's not solved anything in terms of global warming or anything at all with regard to carbon. It just means that the pension fund itself has removed itself from that specific impact that can be attributed to the pension fund. But that is in line with the council's target to achieve neutrality and carbon-free status within a specific time period, and that target applies to RBKC.
Yeah, I think I need to challenge that premise, but we'll come back to that piece. I mean, one of my concerns just looking at this is that you're committing yourself, I'd just be interested in how you propose to do this, to find out the carbon emission status for, I think we probably invest in the best part of indirectly 6,000 companies across the entire globe. And whilst the UK government may stamp its foot and jump up and down, I'm not sure that those companies that probably represent 95% of our portfolio that are not located in the UK will pay any attention at all. And therefore, how on earth are you going to get this data?
The way that that's achieved at Westminster is the employment of specific consultancies who measure that data on our behalf.
But how are they going to do that? How do they know what every single one of 6,000 companies are doing when they're not reporting this information?
That is the data that they contain within their research and their databases.
highly sceptical. Unless those companies are under a legal obligation to report it, it's fiction. Must be.
I mean, actually managing an emerging markets portfolio, it is surprising. Maybe China won't cooperate, but it is at least scope 1 and 2 emissions. That data is more available than one might think. So in a way, we can just ask BlackRock and Bailey Gifford for some kind of figure.
Highly confident that those in every country that's measured the same way and it's
of course
accurately the same.
Of course not. And yeah, and scope 3 is kind of impossible. But
was Mr. Trigg's proposal that we would actually get consultants to do this?
That is one of the recommendations, Chairman, is that we start the process of measurement.
I don't support that recommendation, just to make it very clear.
Sorry, likewise, and with Councillor Lowry, I think we'd be paying people good money to sit at home and come up with numbers which don't really reflect anything real. I don't have confidence that you can go around a global portfolio and get a meaningful number. And I mean, a number of the things pointed out in the paper just talk about how hard it is to measure this sort of thing. When you put a global portfolio, it must be, I think, nigh on impossible, and you're measuring what you can measure. But is that worth it when 95% of things you can't measure or the data isn't believable? So by all means, if our investment funds managers will provide that data free of charge, let's have it. Why not? But I certainly wouldn't be in favour of paying consultants to gather that data.
I don't think we're negating what the council has decided, but whenever our managers come and give us presentations, speak to us, they make a big point about divestment. Even Allen Street had it in part of their presentation, which they didn't speak about. So I think in good faith, an active effort is being made by our managers to reduce their exposure to and carbon footprint per se to these fossil fuel companies. So as was possibly suggested by advisors, we could go and ask if we're not confident a specific manager as to what they're doing. But I think in good faith, our managers are trying to divest away gradually, but with investment in mind as opposed to just a arbitrary policy.
No, I agree. I think our position has always been that divestment is actually is tokenistic. If you're really serious about climate change, which this council is, what you need to be doing is firstly making sure that your managers are taking it into account properly. Well, that's inherent in their job. If they're not looking at one of the biggest factors facing the world in the performance of the underlying investee companies, then they're not doing, they're not good managers. So they, by definition, are if they're an active manager. If they're a passive manager, they don't get that ability to select, but they do get the ability to engage. And it would seem to me a very perverse policy if responsible investors such as ourselves were to lose our say at all of these companies, and we should be using our say to press them to take action on climate change, and handing, by definition, our shares to people who don't care about this issue, who will then presumably say to these large emitters, please carry on, we're very happy for you to do so. So I don't think this action would solely serve to massively skew our investment decisions, but have no impact at all on climate change, which I just, if we were going to pay a very significant investment price, but in so doing have a very significant impact on climate change, well, that's an interesting debate to have. But to significantly prejudice the interests of the fund for no other reason other than symbolism, and indeed, actually, you could argue to forfeit our right to actually have a positive impact. I don't see why this seems to be utterly perverse.
So just to sum up the remainder of the paper, Chair, paragraph 6 looks at the fiduciary responsibility, as might be the perception of members. There could be a direct conflict of fiduciary duties of members to put the return first, and payment of pensions is paramount in terms of the pension fund's objectives. Paragraph 7 looks at the disclosure regulations. As I said, they apply only to the private sector currently. So these rules on disclosures, on measurements, on carbon impact they do apply to the private sector, and we can expect the local government pension scheme to have that same obligation in the short-term future.
So just sorry on that. I mean, if there are rules which either are or about to come in, then we've got to follow them. So if we're mandated to spend money on collecting a whole bunch of funny data, but that's what the Parliament has decreed, then that's what we will do. So I don't think anyone's scepticism here is that we intend to break the law. We will follow the law, but we can publish it and then say we've published it, and that's as far as we're going.
So paragraph 8 looks at the recommended next steps. Obviously, the data extraction is one of those, and then obviously the awaiting the DLUC consultation. That is paramount to get some idea of the framework in which we're working. Just to spill all of this bad news in one report, in paragraph 9, I've included the Leveling Up Consultation, which is a requirement by the department, and it's Michael Gove's ambition as Secretary of State that local initiatives should count within asset allocation up to 5%, with the ambition that in terms of the council's own regeneration housing initiatives and other investment possibilities, that they be funded from the pension fund.
And this is still a consultation, is it?
That's still a consultation.
So actually our response to this, I would suggest, should be lovely idea, like your lovely infrastructure ideas, but please explain how you propose to do this, and please explain to us where all these wonderful investment opportunities are going to be, which are going to offer us similar or better risk-adjusted returns than the assets that we already own, because otherwise you'll be asking us to accept worse risk-adjusted returns than the assets we're already owning, which will mean there'll be a significant cost to the fund, which in turn will be a significant cost to the taxpayer. And so this is just a very expensive way of getting your projects off balance sheet.
Chairman, we can certainly attempt to sum that up in our response.
I mean, the practical question. So in our case, 5%, that's what, £80 million. Who's going to be assessing this £80 million? How, given that we're a pension fund and we're trying to pay the pensions of you mainly, how are we supposed to assess these 80 million? We'd have to employ a whole bunch of people to do this. This is commercial, so this is not spending money. This is an investment. So we as a local authority, and every local authority would have to, think of the cost of doing this, would have to employ legions of people who are expert in investing in probably small companies and small projects, microfinance. I would say it'd be very interesting to see the department's views on how practically they intend to do this. I think we should, perhaps in our response, at least for this committee, and some of us disagree, express a little scepticism about the practicalities of this, and perhaps a little scepticism about, yet again, central government viewing the LGPS as a piggy bank for whatever project they want to do, as opposed to a pot of money which is supposed to pay hard-working officers' pensions, which is sort of how we see it. Colleagues. So I think, look, if you're telling us that we've got to collect some data and we all think it's a bit silly, I would say let's delay in actually doing it until we really are having to do it. And if we have to do it, we have to do it. That's just the rules. I think if in return to the consultation, please government, think again. But again, if you mandate us to do it, we'll have to do it.
Chairman, I should emphasise that the way the wording is set out, it's set out as an ambition rather than a mandatory target. So it should be in our ambition to achieve that, but without the mandatory.
A bit like infrastructure.
A bit like
infrastructure.
Yes.
It still exists, doesn't it?
Exactly
the George Osborne's raid, which was what 20% should be on infrastructure. Well, if they're happy to make it ambition, we can say thank you. Politely ignore. But yeah, so I think your recommendations were, can I just be clear what your recommendations were and what decisions we need to take, so that we also just make it clear for you?
Officers would like to do, Chairman, is in terms of starting the work on what we would need to do to calculate the carbon footprint of the RBKC fund.
And this is in anticipation of a regulation that you foresee coming.
Exactly right, yes.
I think that's reasonable. I think you've heard skepticism, strong skepticism amongst the voting members about the value of doing this. But if you're asking us to agree that you begin to prepare, but don't actually start spending lots of money on it, just sort of get your ducks in a row. And then if they mandate us to do it, we have to follow the law. Yes, no, exactly. We're saying we don't want to spend any money on this because we think it's not going to contribute to the pension fund. But if you want to do some work because you're being sensible officers and getting ready for something you anticipate becoming mandatory, that seems sensible. You know, and if it becomes mandatory, we'll follow the law.
So we could bring an update to the next committee, but without having committed to spend anything.
I think that's the view. Councillor Bennett.
Are you completely sure that the council aim for net zero carbon emissions by 2030 includes a pension fund? Because I remember we voted on that in full council, that this is what's being referred to, and I don't recall the pension fund being mentioned.
I've checked that wording, Chairman, and it does specifically include the pension fund.
I would then interpret it to mean the emissions which are emitted by the pension fund and its committee, which will be the carbon dioxide emitted by the humans in this room and the papers that we are producing. It cannot mean that the council certainly did not debate and discuss mandating that we radically change our entire investment portfolio, which is what this would imply. No, nor do I. And I don't think either group proposed it or would have assumed it. If that's what we want to do, then let's have that discussion in full council. And if that's what our colleagues vote to do, then that's what we'll have to do. I will certainly speak against it. But I think that's not the view of councillors as to what our intentions were. But
I'm happy to take that one away, Chair, and confer with our legal colleagues on exactly what that commitment means for the pension fund.
Yeah, well, I mean, that would force us to divest. It would force us to completely change our entire investment portfolio and incur some very substantial costs. So,
just from experience, generally when you've got managers with a bias to tech, like Bailey Gifford and Adam Street, you generally find the carbon footprint is much smaller than the broader market.
This is true, but of course the BlackRock fund is a market tracking index, so it will track the world. So you would then end up having an even bigger skew probably to technology and other things. And of course, this is why this is such nonsense, because do the people who drive to work at Apple's headquarters do so solely using cars that are using renewable energy? So how far down the chain do you go before you say, actually, this is inextricably, the whole global economy is so inextricably linked? What we need to do as a globe, cut our carbon emissions, not, I think, start pretending that if you sell this company, you've actually made any difference at all. It's my personal prejudice anyway.
Chairman,
sorry, yes.
Could I chip in momentarily? I'm a trustee of probably one of the most influential pension funds on these issues at the Church of England. They're the founders of the Transition Pathway Initiative, key players in Climate Action 100. And they've succeeded in doing many of the things that we've talked about and dismissed in this conversation. And things like the data quality they get from their advisors on carbon emissions is actually very useful and reasonably well aligned across the data providers. So, I mean, there are lots of statements that I've heard in this evening's conversation that contradict my experience of being hands-on in one of the leading organisations. I wouldn't claim that I have been one of their leaders. They have led, and we as trustee body have kind of ridden with them. But actually, there's an awful lot you can do without incurring significant cost. And there's an awful lot you can do actually without having significant change to your investment portfolio, investment performance in terms of risk and reward, but simultaneously massively reduce the carbon intensities.
But what have they achieved that's positive? How many carbon dioxide molecules have been emitted as a result?
They've had fundamental impact on the strategy of Exxon. strategy of Shell with change of board members on Exxon, and strategy of BP.
But by being shareholders and telling two things.
Well, by being in some of those by being shareholders, and some of those by actually disinvesting and saying until you under the transition pathway framework, unless you are going to make the changes we're asking of you, we are not able to be your shareholders, and have managed engagement with about 40 trillion AUM behind them. To actually, clobber the senior management of those big organisations. So there is a whole world and a whole programme and very effective engagement out there that operates with a fairly different perspective from here. I don't want to sound like a zealot, and it's 9:30.
No, it's good. It's
just a different mindset.
So I asked you, I mean, I think we did look, and Mr. Triggs, remind me, we looked through the LAPFF, whether we could in turn join some of these bodies. But I think the point that I understood from those bodies was that they were pursuing the path of engagement with management, not divestment.
Well, it's both. So, sorry, I don't want to take the whole evening on this, but there's a very positive engagement with Climate Action 100 and Transition Pathway Initiative of saying, do you meet our criteria? If you do, we are willing to be weight up in you. If you don't, we'll weight down. If you're really bad, you drop out of our indices. On something like Climate Action 100, it's much more engaged and direct on the specific resolutions. What is your strategy on Paris compliance? Is your stated strategy compliant? If not, putting resolutions through AGM saying not, demanding of them that they publish what their strategy is. So it's not about necessarily beating them up, but it's about asking them to communicate what they're doing on their supposed stated aims. And that has been extraordinarily impactful on some of the extractive industries.
Which I think we would subscribe to, but that requires you to remain an owner. The minute you divest, by definition, you're selling someone who's not.
In practice, no, because actually they're so powerful that members of the organisation cannot be aren't necessarily shareholders, but the mere fact that they are supportive of that strategy is is quite influential on the likes of those big oil senior management. So yes, you need voting, you need block voting. But the engagement, for instance, by the Church of England with BP was done with trivial shareholdings.
Very quickly, having a strategy of reducing carbon or acting in a way within the market to reduce carbon, I can absolutely see the value of that. That's quite different from trying to calculate what the carbon emissions is.
Well, that's a key input and relatively easily done by quite a few of the advisors.
Say again, sir?
That's a key input and relatively easily provided by a number of advisory services.
One active manager, and as an active manager, I can assure you that Baillie Gifford will be doing it. So there's no extra work involved. We just ring them up and ask them.
Yeah.
I'm conscious there's a huge debate to be had here, and this isn't probably the time or the place to be.
I think that's correct. No, but it is a really important discussion.
I was about to say, well, this is why we're dependent on Russian oil.
Indeed. So yes, we shut down all of the people who produce the products that all of us use, and then we go to lovely Mr. Putin and buy his stuff instead.
As you know, Chairman, I spent most of my career working for an oil company, so
you're well versed for the subject. But just I want to be on interest of time. I know we're getting rather late. So the recommendations were that you wanted our authority to go and begin the work. What we've said is yes, begin it, but don't spend any money. And then if we're required by regulation to spend money, we'll spend money. That was the sole recommendation. Okay, and Councillor Laurie has to go. So and then we'll be in Corad. Okay, good. Can we move on then to the business plan? This is for decision again.
I can be brief with this one, Chairman. This is the proposed draft business plan for next year. The key document that you will receive at the next committee meeting is the outturn report for this current year's business plan and what we've achieved and what we can reported as to the objectives and aims that we've set out and exactly how we've achieved those. So that will be at the next meeting. This is just a draft. We're happy to take feedback from members if there's any queries or questions or changes or edits we can incorporate those, but it's basically the plan of our work for next year.
Okay. So far as it affects us, it's investment committee FG and H. The rest is not things that we're having to do as a committee. You're doing or other people are doing. I think I'm quite happy with FG and H. Are you all happy with FG and H on page unnumbered? Yes. I'm going to take that as consent. Thank you. It'd be useful if we could, on the expenses side, again picking up the comment around Adam Street, if we could just show percentages against these numbers, just so we get a bit of a sense on them. I mean, percentages of our assets under management, because of course, whilst the fees may be in pound terms, whatever they are, the assets have gone up quite considerably. So, good. What's that bit? Oh, responsible investment strategy.
Yes, Chair. All that was required was just to for members to approve those statements, unless there are any final requests for any edits or changes.
Wasn't this the one we were supposed to give you comments on?
Yes, Chair.
And we haven't given you comments on. So it's just we need to.
I mean, officers are happy with the drafts as they stand. Happy for members to approve.
I'm just trying to remember, but isn't this the one that we have an action to come back to you on? Are you on the action?
Yes, we did ask.
We haven't done it.
No,
and
that's the case.
We said that we're very bad and we ought to. So I think we shouldn't approve it by default. We should do what we said we were going to do, we the committee. So I think we're not approving it, and the fault is ours, not yours. But we will definitely need to approve it by the next one. Is there any other business anyone wishes to raise? Sorry, this is not a long meeting. In which case,
Chairman,
please.
It is Mr. Bertlin's final meeting with us tonight.
I didn't know that. Well, can I express my thanks to you for all your help to the committee and to the fund over the past few years, and we will miss you, and I hope you're going on to do lots of fun things.
Well, I'm looking to retire, which should be fun. But thank you very much indeed for giving me a very stimulating experience. And I'm glad to see that the fund here is in such an extremely good position.
Thank you. Well, thank you for everything you've done to contribute to that. So.
And I'm here. My colleague James Brundett will take over, and I'm sure will do a much better job than me, and ensure that you remain in a very good condition.
We'll hold him to that. No, but thank you very much for everything. No other business, in which case the meeting is closed. Thank you.